Hey, everybody. So the question is, will mortgage interest rates actually go to zero? So today we have DGolden with Cornerstone Home Lending with us, and he's going to take us through this very important question. Plus, we have three other questions from folks on the list that we're going to answer, or actually Dan's going to answer. So in the meantime, make sure, subscribe, share the information. By subscribing, it just lets you know when we do these updates, which is every week and sometimes 2 times in a week, so that you get real-time information. So with that, Dan, the question,
Yes, George.
Are interest rates going to go to zero?
No, the quick answer is no. I get this question asked a lot of me, and what people have to understand is that when you hear that the Fed has lowered the rate to zero, or they're talking about maybe taking it to a negative number at this point,
right?
The banks still have to make money on that money. That's the money that the banks are borrowing the money from the Fed. Then they add their margin, which is about 3% or 3.25%, and that's where you see the mortgage rates. So
okay, so hang on a second.
Yes.
So you said today, as we were gearing up for this video, that you said rates were like 3.125.
That's right.
And you just said that banks need to make a profit of 3%.
Right around there, yes.
So what you're saying is that the Feds are lending at almost zero now.
Right.
So they're almost there, and even though it sounds zero like a big thing, it's really not a big thing because they're almost there.
Right. The headline says zero, rates are zero, but that's not to the consumer, that is to the banks.
Okay. So is it safe to say that when we talk about, banks making their profit, however, interest rates going to zero, when the Feds talk about going to zero, not only is that for rates that are based on what we call par pricing, then what is created for banks, right? As far as their par pricing for the day. So it's the Fed rate plus their margin.
That's right, yep.
Okay. All right.
And that can also, there's some things that also can make that fluctuate, mortgage-backed security, demand for mortgage-backed security. So there's more to it than that. I gave you the simplified version, but
that's what they want.
Yeah, that's
all right. So Donald, I hate to break it to you, buddy. The answer is no. We're not going to see mortgage interest rates go to zero. Sorry. But wouldn't that be cool? That would be amazing. All right. So let's see here. So Lita Lorenzo asks, Dan, how much is the mortgage interest rate, and is it going to be flexible?
So the answer to that is yes. There are lots of flexibilities within the rate. So the normal rate's around, like we said, 3 to 8 today. If you wanted to take a slightly higher rate, you can do that, and that would give you some credit towards your closing costs, so less money out of pocket. You could also buy down the rate, so you could, instead of paying 3.125, you could pay maybe a point and get down to 2.875, something to that effect. So pay more cost to get the lower rate.
Okay, so let me get this right. If somebody's willing to increase the rate, say, let's use an example, 1/8 of a point, okay? And maybe they're short on cash, okay? They could actually, the bank would actually credit them money up front so they could keep more money in their pocket.
That's right.
To go ahead and complete a purchase.
Right. We would give you what's called a lender credit towards your closing costs.
Okay,
and that can be thousands of dollars.
Now, can that be applied maybe towards mortgage insurance? Because some people get scared about mortgage insurance, saying, "Oh my gosh, I just don't want to. It's a crazy number. I'm going to pay it forever."
Right.
Can we pay that?
Yes, you can. You can buy out the mortgage insurance with that lender credit. You can do anything you really want with it towards certain things that are cost items on the transaction. So,
really?
Yes, you can do that.
That's pretty cool.
Yeah.
Now, I'm going to take it the other way. Now, you said that if I were to pay money in advance, I could get a lower rate.
Right, and that's what we call points.
Right.
You'll hear that being called points out in the market. So you can pay points to lower the rate. We're at some all-time lows in the market right now.
Mm-hmm.
And some people want to, let's get the even a little bit lower rate and lock in. Like I said, I think I quoted somebody 2.875 with 1 point. So under 3%, and that's, I think it was actually 2.75. It was even lower than that. But you can obtain those rates, and if you're going to be in that house long term, grab that rate while you can.
So that makes sense for a long-term type of hold.
Right.
If you're going to hold it for 5 or 6 years, that probably doesn't make a lot of sense.
Probably wouldn't do it.
Okay. All right. So because, it's dollars and cents, it all comes into what makes the greatest amount of sense. I'm going to ask you a really tricky question.
Okay.
Here's my tricky question.
Okay.
Every once in a while, we get these phone calls.
Yeah.
And they say, George, look at this rate.
Right.
It's like 2.75.
Right.
Just kind of like you quoted.
Right.
Right? But par pricing is like 3.125.
Right.
And they say, oh my gosh, this is amazing.
Right.
What's going on there, Dan, that they need to be aware of when they see these almost crazy low rates that is lower than everybody else?
Well, I think people need to dig a little deeper because most of the time those are going to have points associated with them. They're just not that evident in the advertisement they're seeing.
Right.
And so those points are probably there. They're not always there necessarily. There's different factors that could make their rates slightly lower. But for the most part, you're going to see there's extra costs to obtain that rate, which
A buy down.
Yes.
We have a buy down of points to
Right.
get to that rate. Kind of what you would just describe for your client, where they were paying extra dollars to get a better rate.
Yeah, a lot of lenders like to show the lowest rate out there, and then they don't kind of hide the little detail. So you got to dig deep on that stuff.
Okay, so if somebody is looking at a crazy rate like that, give you a call and say, hey, how real is this?
Right.
How well can you compete with this?
Right.
Because you're pretty competitive, right?
Yes.
And will you do the best job possible for everybody that we refer to you
I
and
will.
whatnot?
I'll do the best I can. I'll put my best foot forward, and the other thing with that, we try to provide is we provide really good service. Like you'll get me on a Sunday or a Saturday. We can do 11-day closes. There's a lot of value in the service we provide.
Right.
But I also think we're competitive at the same time on the rate. So
I think so.
The best of both worlds.
Perfect.
Yeah.
All right. Hey, so let's move on. So we've got a question from, you'll have to forgive me, I think it's Hailu Ayeli. How are the recent prices, I'll address that one, and mortgage rates in the midst of this pandemic? Are mortgage rates benefiting, or is it catastrophic for buyers right now? And
rates
refis.
are at an all-time low, and it's mainly, a lot of it is due to the pandemic. The stock market tanked, as everyone saw. It's starting to slowly inch its way back up, but rates were definitely affected by that. I don't think rates would have been where they are hadn't the pandemic happened. So,
would we still be back at the 4.5, 4.75? Do you think?
I don't know where we would have been, but I think we would have been around 4, at least in the 4s.
At least.
High 3s, low 4s.
Okay.
Yeah. So this definitely helped.
Because a year ago, right? So January through March, we were 4.75. Every once we'd bump up against that 5%. And then as, the pandemic started becoming a little bit more realized internationally, and there was a lot of volatility in the stock market, and in the May, June, July market, as you guys can see here, right? We can see that this is where interest rates were coming down. Marie will post this chart so you'll be able to see it better, but there's this big hump here. That's when interest rates started coming down into the low 4s, right?
Yeah.
And then all of a sudden, we started getting into the high 3s and then the mid 3s as we had more of the stay at home, as the volatility of the market.
It tracks the stock market. When the stock market goes down, typically you'll see rates go down. It doesn't always happen that way. It's not exactly a symbiotic relationship, but as the stock market starts to go down, rates will go down. And I'm a firm believer, in my opinion, the stock market's got more downward trajectory, and I think rates could follow. I don't know if they'll follow like down to 2.5 or 2.75, but there is a decent chance that rates will continue to go down over the next 6 months, in my opinion.
I brought my crystal ball polish. Should we break it up?
Yeah, break it up.
All right. So just to be clear with everybody, so the stock market goes up and down every minute, every hour, every second, right? Do mortgage interest rates?
They do.
What?
Yeah, they can change in midday. They can change, obviously, day to day. They've been pretty stable over the last couple of weeks.
Okay.
Like these rates have been pretty in that 2 7/8 to 3 1/4 range, 3 3/8 maybe on occasion, but they've been staying right in that little area right there. And but yes, rates can change. I think yesterday rates were a touch high. I think they're going to be lower on Monday. I can kind of predict it,
Okay.
but don't count on it. It's my best guess, but I can kind of predict it.
Okay. So that would be a guesstimate, then.
It would be a guesstimate. And
All
I've
right.
been wrong, by the way.
Second, I got a technical
Made
question.
mistakes on that, or not mistakes, but I've been wrong on my
On your,
assumption.
all right. Well, we're all wrong occasionally. I was wrong once last year. All right. I'm just kidding. All right. So, tricky question.
Okay.
If somebody says, Dan, I want a quote from you, and you get it in the morning,
Right.
3 hours later, could that be a different rate?
It could be.
And so now they're not comparing apples to apples.
Right. So if they're out there shopping or comparing, and we're in a 3 or 4 hour difference, and when they receive those two quotes, they could be different because just the market changes. And a lot of times, if I'm the guy who gave them the first quote in the morning, my rates have gotten better as well.
Right.
So it's a tough thing, and it's not quite as volatile as it was. So
Right.
that's not happening as much as it was.
Okay.
It's, like I said, it's staying pretty stable. And I try to honor any quote I give for the full day, unless it's just an amazing difference, amazing spike happens.
Okay.
If I quote 3 1/8 with no points at 8 o'clock in the morning on Monday, and they go up a little bit Monday afternoon, I typically will basically take the hit on that.
Okay.
And honor that quote. So
Okay.
yeah.
Right on.
Yeah.
Strong work, Dan.
Thank you.
Right on. Okay. All right. So we got another question here. All right. Let's see here. Hannah asks, she says, George, are jumbo loans actually still in existence? Because I was told that the banks just are not offering jumbo loans again.
That's not true. They're still out there. They're definitely more restrictive, but they're not that restrictive. They just added some guardrails on them.
Mm-hmm.
A little bit on the ratios. They don't exceed a certain ratio, debt to income ratio. That's your debts compared to the income you make. The reserves have gone up a little bit. So reserves are money you have after closing. And a lot of times lenders will want to see jumbo loan products will want to see 6 to 12 months of reserve money.
Okay.
So if your payment's $3,000, they want to see $18,000 left over after closing and down payment.
Okay.
So that's the reserve requirements have gone up a little bit. And they're just scrutinizing income. They're making sure you're not on the verge of being laid off. They're scrutinizing self-employed a little harder. So it's just a little bit more scrutiny. They're not gone. They're still there. And we're closing them left and right. But they are a little bit more restrictive. So there was something out in the media that said jumbo loans are gone or something like that. That's not true.
Okay.
They're still out there. So
Perfect.
and the rates are still good on those. They're not quite as good as these, but they're good. They're good. The rates are good.
Okay. Have you seen an uptick in not only refinance but mortgage applications right now?
Absolutely. Yeah.
Like is it just a little uptick?
No, my volume and our inquiries are up probably 2 to 3 times the normal. Just because,
2 or 3x.
Yes, so 2 to 300%. The mortgage rates being so low.
So when we look at this number and we look at this number, because these are our month to month for this week, okay? So we have appended sales, we're up 28.6% month over month. We're only down during what was considered one of our greatest markets. We're only down 8.2% year over year. Solds are up 46.7%, which is where the tire hit the pavement. This is kind of what you're talking about when you say 2x, 3x of. So here's the question then. Should people be waiting for this lower interest rate? Is there a tactic maneuver that somebody could do to, let's say, hedge against this, right? So let's say I wanted to kind of buy a little insurance to, hey, I want to capitalize on today's rates, but if they go down lower, say in 6 months, how do I capitalize that without, creating just this monetary disparity in my checking account?
Right. Well, number one, even if you locked in at 3.125 today and the rates went to 2.875, you're still by far in the greatest shape of anybody you probably know that bought a house in the last 20 years. So you're still in a very good rate situation. If you have the thought process or you have a feeling that rates will go down, which I actually think they might go down a little bit. I don't think they're going to go down dramatic, but I think they're going to go down a little bit. And I wouldn't wait on the sidelines. one tactic that I've been doing with a lot of clients is instead of giving them the rate of 3.125,
right?
And I have an example of a $640,000 loan that I just quoted somebody, and I quoted them 3.125 with no points. I also quoted him 3.375, just a quarter higher, which is $80 a month in payment for no closing costs. So they got this.
So they get to keep that like $4,500.
$4,500 they save. So what that does for you, if you think rates are going to say 275 in 6 months, and you want to grab that rate, take the 3.375, 3.4. I'm gonna
make it easy there.
Sometimes people hear 3.75, it's 3.375.
Right.
So just about 3.4%. So you take 3.4, and then next January, February, if you think rates are going to be at 2.75, for example, refi at that. You can refinance that loan to 2.75, pay the closing costs. Then you haven't paid any closing costs, right? In the initial transaction. And if you count, if you figure out what that cost you, it's $80 times 6 months, $480
versus $4,500.
Exactly. So
see, because we're math whizzes here.
Yeah, then you pay your $4,000 or whatever refi costs are.
Right.
Refi, and you're way ahead of the game.
That is just absolutely a fabulous way of hedging.
Right.
If you think rates are going to drop lower. Right. Plus, you get to keep the money in your pocket.
Right. And worst case scenario, if the rates don't go down,
you should have a great rate.
3.375 is not a bad rate. 6 months ago, people would have been dying for 3.375.
Absolutely.
And so just be aware of that. People get caught up in, I want the very best 3.1 versus 3.4. It's not that much of a difference, an $80 per month difference. That's on a 640 loan amount. That's a pretty big loan amount.
That's a big loan amount.
So if it's a 320 loan amount, it's more like a $40 difference. So
right.
It's not that big of a deal to give yourself the opportunity to possibly have that lower rate in the future. So,
and if you're curious about what that true cost is, take $80 and or take $4,500 and divide it by 80. That's how many years that's going to take.
About 5 years.
For you to get that back.
4 months.
I was walking him through the math. He took the wind out of my sail.
Sorry.
I'm just kidding. All right. Okay. So everybody understand rates are not going to zero. It's just not going to happen. Dan just gave you a great way to hedge against if interest rates are going to continue to go lower without just absolutely robbing out of your account. That's a brilliant idea, Dan. It's strong word.
I do that a lot for people.
You do have what?
I do that a lot for people. I explain that when people come to me asking for a quote. I say, you should never pay closing costs if we're on a downward rate trajectory.
I like that trajectory. That's like a good 25-cent word for the day. I like that. All right. So if you guys have any questions, Marie and May, they're going to post Dan's contact information. Definitely take a look at it. If you have questions, ask him. If you have questions, post it up there for us. Make sure... oh, my shout out. We almost forgot. Thanks.
No, you almost forgot.
I almost forgot.
Sorry.
Man, it's a rough course here. So, I said to Jamie, my wife, I said, hey, this is absolutely amazing. One of our clients just got engaged. And I said, I'm going to do a shout out on Facebook Live. And she looked at me and says, well, be nice. And I said, what do you mean? I'm always nice. And Dan, she gave me the look.
Oh, no.
The look. The look that only a wife gives you, like, So anyway, Melissa and Kevin, congratulations. Kevin, we'll have our intervention for you, and we'll make sure you're taken care of. But anyway, absolutely congratulations. They just got just engaged. They're out this weekend having fun, and we wish you guys all the best, and I hope you guys had a great time and a great future. Anyway, with that, everybody, remember to subscribe so that you always get the updates so that we can keep you abreast of where things are trending, both in real estate and in mortgages. And in the meantime, you guys stay safe. Have a great day.
Great day.